Now let's talk about calculating cash flows from financing activities. To calculate cash flow from financing activities, the balances for long-term liabilities, equity accounts, and dividends must be examined. In general, an increase in a liability or an equity account, like common stock, for example, as an equity account, suggests that a cash inflow from either borrowing or selling stock took place. So that means the opposite, a decrease in a liability or an increase in treasury stock or dividends, would suggest a cash outflow from payments to creditors or investors. Cash flows from financing activities include cash inflows from selling stock or issuing bonds. So now remember, now we're talking about financing, so when we talk about stocks and bonds, we're talking about the company's own stock or bonds. Cash inflows from financing activities also include contributions from owners and borrowing from banks on a long-term basis. Cash outflows from financing activities include repayment of notes and bonds, cash payments to repurchase stock, so we call that treasury stock, and the payment of dividends. Once again, all interest payments are included in cash flows from operating activities because those come out of net income. So here's a model statement of cash flows using the indirect method. Remember, we talked about the direct and the indirect method for computing cash flows from operations. So notice after the three cash flow activity sections, the statement concludes by adding the change in cash to the beginning cash balance to derive the ending cash balance. So you can kind of think of this as a reconciliation of cash. So our change in cash was $27, or a decrease of $27. We add that to the beginning cash and we get the ending cash. So if we want to analyze the statement of cash flows, we can use this statement to answer a few questions about a company's cash. So two of the broader questions are, is the company able to generate enough cash to grow? And is the company able to generate enough cash to satisfy its obligations? And so let's go through how we use this statement to answer those two main questions. First, let's talk about free cash flow. When we're assessing a company's cash flow, a commonly used calculation is free cash flow. Free cash flow is the cash a company generates in excess of its investments in productive capacity and payments to stockholders in the form of dividends. That's how we give money back to the stockholders, is by making dividend payments. So free cash flow then is a measure of a company's ability to generate cash for expansion for other forms of improved operations, for the repayment of debt, or for increased returns to stockholders. So free cash flow is basically what they have left over, and that's why we call it free, because it's free to be used however the company wants. One thing that we want to keep in mind is that it is positive to have negative free cash flow. That's not a good thing, but it's not the end of the world if the company is going through some sort of short-term expansion or they have some plan for turning things around. Also, you can kind of think of free cash flow as a moat. You know, think about the castle, and to protect ourselves from enemies, we have this moat of water around the castle. So the higher the free cash flow, the larger this moat, and therefore the more protection we have against negative things in the future, or the more protection we have to go out and trying to think of a castle reference, but you know, it's still that protection between us and the outside world, and so the bigger the better. So let's talk a little bit more about positive and negative free cash flow. Obviously, we want to have positive free cash flow because that is generated when cash from operations is more than the amount that we pay for property and equipment and dividends. So as a result, in that case, the company generates cash that is free to be used for other purposes, like we just talked about. A negative free cash flow, however, is experienced when a company spends more cash than is generated for operations. So that's a function of both a decrease in cash generated from operations and an increase in capital expenditures. So you can see here in our Under Armour example that we've kind of been going back and forth on, they've got positive free cash flow. Now, one thing that may be concerning is that positive free cash flow is decreasing from 2009 to 2010. But you also see a dramatic decrease in cash flows from operating activities and then an increase in capital expenditures. Another way that we could analyze a statement of cash flow is through the cash flow adequacy ratio. So this second ratio is commonly used to assess a company's cash in addition to looking at free cash flow. The cash flow adequacy ratio compares free cash flow to the average amount of debt maturing in the next 5 years. So because this ratio compares free cash flow to maturing debt, it represents a company's ability to generate enough cash to pay its debt. So in general, companies would like this ratio to be higher than lower. That makes sense, right? Because it's telling us how capable is the company of repaying their debt as it comes due. So all other things equal, a higher ratio indicates a greater ability to generate sufficient cash from operations to pay upcoming debt. And so now we've covered the statement of cash flows from the operating activities section with both the direct and indirect method of calculating that type of cash flow, the investing section, the financing section, and then the analysis.